Welcome back to the Talking Hedge. I'm Josh Kincaid, Capital Markets Analyst and host of your Cannabis Business Podcast. Back with us, Rohit Srivastava. He's the Chief Investment Officer and Portfolio Manager with the C3 Fund to talk about some risk mitigation, risk management using artificial intelligence. He's got some technical analysis to talk about maybe. His whole predictive analytics, a lot of interesting things. But first, people want to hear about the disclosure.
Thank you, Josh. The disclosure here that this is all for entertainment, this is all for learning, and we're not advising anything as to how to do stuff and what to do stuff. This is more telling about how we do stuff. So take it as an entertainment and learning, and use your own thought process and analysis to do your investment. Well, today, like Josh said, we will be focusing mostly on risk management, but who we are an AI-based, data-driven predicting analysis tool, which basically uses machine learning and AI and machine learning to identify investment in three major industries: Chinese industries, cannabis industries, chips industries, and this can be extended to any industry, but we're focusing on these three. And what the tool we have is called a smart frequency trading, which is an AI-based tool and uses different models to do investment. Now, just giving you an overview of what basically it does is it does the capital preservation and risk management. Whoever has invested money is in a fund manager would understand how much capital preservation and risk management is important to any kind of investment. It understands how the investment is done. It looks at patterns and recognizes those patterns and tries to follow and invest based on that. It does its own technical analysis, uses different kinds of regression or AI-based predictive analysis tools, and identifies the most efficient stocks to invest in. And most of these trades are automated, and that's how this tool was built. And these are the four aspects of the smart frequency tool, which you're seeing that. But today, what we are focusing on is risk management. We're focusing on risk management as to how do we avoid the different types of risk happens in investment. Before we jump into that, let me tell you the iconic investors in this industry. They all believe that these investment cannot be done emotionally. Any kind of investment cannot be done emotionally. If you have to have emotion during your investment, you're probably not the right person to be investing in that. And that's which comes to risk management about that. And that's what the whole AI tool is to keep the emotion aside and invest completely based on data. Now, the different types of risk management which you address is a systemic market risk and a non-systemic market risk. So in a systemic market risk is basically if the whole entire market is going down, like you guys might have seen at the end of February when the whole shutdown happened, the whole market was turning down. It doesn't matter. It didn't matter. It was Tesla or Apple or any other stock. They all were falling down. It is uncontrollable, like you might have seen that it's uncontrollable during that time, and it impacts all securities. It doesn't matter which security it is. And the non-systemic is basically which impacts a specific industry. Like, for example, the cannabis stocks have been going down for the last 2 years, like consistently going down. It had nothing to do with the market. It was just that there were some reasons why the market was going down. Or well, that's a good example. And it's basically related only to a specific stock or specific industry. Well, but we are going to address the third type of trade risk, which is the trading risk, because our AI system buys and sells on a consistent basis. So there is a trading risk, and the trading risk, which is the one, is the lack of discipline. Whoever is a trader can understand this a lot better, that discipline is the number one thing. And as a human, discipline, everybody has trouble with that. The second part is the tax risk, which is a wash sale. And what it really is that IRS and SEC, they avoid people buying and selling consistently and taking losses. So what it really is, for us, as to simplify, is that if you buy a stock and it loses money, and you buy it again and lose it money, the second time you can't take a loss on that. You cannot write off the loss on that. So it has to be tax efficient. So, but if you take too many losses, you might not be even able to write off those losses. So that's what the trading risk, part of the trading risk is. Now, let me address each of them. The systemic risk. So the loss is due to the market turning down, and our AI tool, what does, it basically has a market downturn indicator. What it really does is that it identifies different data points and identifies, is the market at risk? And what it does is it basically helps the fund to pull the money out of the market, and pull the money out of the market so that it's not in the market. Now, most of the time it has worked out fine, and sometimes it has not worked out fine. But when it has not worked out fine, what it really means is that we have not invested in the market and we have lost an opportunity. But that's a lot better than losing a lot of money. And that's what this tool does. So let's look at the data, which basically at different points in the last 2 years, 2 to 3 years, we basically have saved tons of money. So, for example, like you can see on 2/19, just like the 2 days before the market crashed in 2020, our market indicator basically identified that there is going to be a market fall in that. Now, sometimes, like you can see on 8/24/2020, it said that the market is at risk, and it pulled out like a week or 2 weeks before the market, and we kind of like lost a small run on 1 week. But that is the risk we're taking. Ultimately, the market fell down, and it fell down to about another 10%. So this is the pattern of how market indicator does. But what the key part out of that is, we pull out the market, all the money from the market, we do not invest it in the market, and basically we basically are ahead due to not being in the investment. And that's how we manage the systemic risk. To address the unsystemic risk, the way we do it is we diversify the investment. And diversification, I'm sure everybody's aware of how diversification works, is look at so let's assume that we have $1 million fund. And what we do is basically we buy a $20,000, multiple stocks of $20,000 each. That would be like a 50 stocks of $20,000 each. That would be $1 million. Now, let's take an example of Facebook. Now, Facebook on 26th of July 2018, it fell by 18%. Now, if it was like $1 million or something like that, it would have been like $180,000 loss. But we had diversified so much that about $20,000, that the $20,000, 18% loss on $20,000 was about $3,600, which accounts to about 0.003% loss on the overall fund, which is $1 million fund. Now, that's what the point is about, that even though there is a big loss, the amount which is lost is so minimal that it doesn't really impact the whole fund. And even a loss of 18% on a stock, effective loss on 18% on one day, basically it affected only a 0.003%. And that's how we handle the unsystemic loss, which is a diversification. Now, the third type of loss, which is a trading loss, the lack of discipline is more human. And that is where the AI comes in, is most of the decisions are made very rationally. And if it's a decision to sell, it's a decision to sell. If a decision to buy, it's a decision to buy. It's not related on an emotional that, oh my God, I think that Netflix is going to do awesome tomorrow, so let's go and buy Netflix. It's completely based on data. Or if a stock has lost enough and say, enough is enough, we cannot sell it, a human might like, you know what, I want to give it more chance. But the AI system takes a hard decision and sells it. Watch sale is another one which I explained to you how it does. So it's all mathematical, and it understands the risk return when it's actually ready to buy or sell a stock. And based on that, it makes a decision: should I sell it or should I not sell it? And combination of that is what the AI system does. So overall, the types of risk we manage is the systemic risk is handled by a downturn indicator. The non-systemic risk is identified by the diversification of investment. and the unemotional and tax efficient decisions are done by the AI system. But they all are done by the AI system, and that's what our AI system is. The smart frequency tool, which manages risk and preserves capital. At the same time, it tries to identify the most efficient and the most beneficial stock to invest in. And that's all I have for you, Josh, today on risk management.
Yeah, beautiful presentation. The one thing I want to highlight is for somebody who says, who cares what's in it for me if they're an active portfolio manager, one thing I want to highlight is the fact that you have predictive analytics. So in an event where systemic risk draws a behemoth like Bank of America or Citigroup down to sub $1 trading levels, where Bank of America was trading at 99 cents back in 2009, systemic risk means that there are no buyers. So even if you have a trailing stop loss, it may not get triggered because there are no buyers. Everyone is selling. So having the predictive analytics with the C3 fund is crucial in times of chaotic chaos. And so if you can have those 2 days or whatever it is, where you can have the opportunity to get out and then let it crash and then allow the AI system to get back in at the trough and reach you close to the peak again, that's how we get our most of our gains week after week, month after month, beating the competition at the end of the year. So we don't have to have the crazy swings that you see from other competitors like Podex and MJ because they have to trade with emotions in order to dig themselves out of a hole consistently. We don't have that issue. But I would look at systemic risk moving forward into 2023, potentially when the markets could get a little crazy as billions of dollars are transferred from the LIBOR to SOFR. You're going to want to have a tool like C3 funds, predictive analytics, to get you out before systemic risk brings all of your finances to 99 cents. That's all I got. So I want to thank my guest, Rohit Srivastava. I appreciate you being back on the podcast, talking about risk management and AI. Appreciate you being back. That's Rohit Srivastava, Chief Investment Officer of C3 Fund.
Thanks, Josh, for having me.
Appreciate it. I'm Josh Kincaid. This is The Talking Hedge. Don't forget to like, share, and subscribe, or don't, and I'm out. Don't forget to smash that like button on your way out and check out these other videos that we've got.